specifically from the lens of an investor. What are the particular implications for capital markets, and what opportunities might become available or risk might become more acute that we would want to be able to better navigate in the coming months and indeed years ahead. On today's agenda, we're going to take a quick look at an overview of budget estimates. We are going to review how or what measures are available to the state in terms of financing the fiscal deficit. We're going to take a look at some of those proposed fiscal measures, as well as the potential impact on investments and investor markets and the sentiment. And finally, we're going to consider what investors should be expecting or should be cognizant of, and which factors could very significantly move markets in either direction, up or down. Just a couple key housekeeping rules during the webinar. Please feel free, and we're encouraged definitely that you submit your questions at any time using the chat box to the lower right-hand side of your screen. The presentation time is going to be approximately 25 to 30 minutes. Questions will be addressed at the end. You can still submit your questions at the end of the presentation. And whatever questions we don't answer, we will try to get out, as we usually do, to everyone who would have joined the chat or the webinar rather, via a question and answer worksheet at the end of the presentation. So let's get straight into it. And we are looking at the overview in terms of budget projections. And for fiscal 2021, revenues have been projected somewhat optimistically in the eyes of a couple of observers at $41.4 billion. Now, the reason it's been viewed as fairly optimistic is because just a week before the budget was delivered, the Honourable Minister of Finance would have noted that even under the most optimistic scenarios, revenues would struggle to get into the $40 billion range. So expenditures, meanwhile, have been pretty much as expected, fairly sticky at around $49.6 billion. And the fiscal gap is estimated to be $8.2 billion for fiscal 2021, roughly half of the projected $16.8 billion for fiscal 2020, but certainly still quite a big gap to be filled. Now, the Minister of Finance did not provide any growth projections for fiscal 2021, so we are basing or reporting projected figures by the IMF back in April for Trinidad and Tobago of 2.6%. For fiscal 2020, however, real GDP growth was projected at minus 6.8%. So certainly some sharp contraction in the economy there. Now, the question, of course, is, will this be a risky revenue recovery based on guidance provided just 1 week before the budget and what was actually projected or put forward for the fiscal 21 period? So for fiscal 2021, that $41.4 billion figure is comprised of $9.3 billion in oil revenues, which would be one of the highest levels, if achieved, over the past 5 fiscal years or thereabouts. The highest level of oil revenue achieved would have been in 2019, the 2019 budget year of $10.7 billion. Otherwise, oil revenues would have been around the $6.3 billion level in fiscal 2018 and 2020 projected. Also, non-oil revenues are projected at $31.2 billion, which is above the projected $27.3 billion for fiscal 2020. And again, certain questions will be asked by investors as to how risky is this revenue projection. And some of the factors driving these riskiness considerations would include, particularly on the non-oil side, the fact that income tax allowances for taxpayers have been increased, which would lead to a loss of revenue of approximately $750 million. The Minister of Finance would have suggested the rationale behind that, and we'll discuss that a bit later. Lower corporate profits coming out of a taxation year in which most private and public companies would report significantly lower taxable profits would also lead to lower revenues. Additional capital allowances going forward would also lead to lower revenues in the new fiscal year. And of course, the minister would have alluded to the Trinidad and Tobago Revenue Authority, which would expect to deliver up to $5 billion in additional annual revenue in a best case. There are going to be certain implementation challenges, particularly getting the cooperation of the opposition, who has been adamant against new taxation measures under the current environment and circumstances. On the oil side, we can see that there's some projected revenue stabilization. The budgeted oil price of $45 is pretty much in line with the EIA's estimates of $44.70. And production isn't expected to increase significantly in fiscal 2021 at around 60,000 barrels per day. Subsequently, in subsequent fiscal years, that production is expected to ramp up to just around 80,000 barrels per day, but not in the short term. Similarly, on the natural gas side, it seems as though we are banking on better prices, and those better prices would come in the form of budgeted natural gas wellhead prices of $3 per MMBTU, which would be almost 50% improvement on the price per MMBTU based on Henry Hub prices currently, or which would have been averaging around $2 per MMBTU in fiscal 2020. Production also is expected to remain fairly stable at 3.2 BCF, but certainly below those production levels of 3.6 BCF in fiscal 2018 and fiscal 2019, when there was also much better pricing, with Henry Hub average prices at around $2.90 per MMBTU. So those are some of the factors driving questions such as how risky is the revenue recovery story for fiscal 2021. Expenditure, as mentioned, has been fairly sticky. Capital and current expenditure is going to total $49.6 billion, as mentioned. So no major changes there when we compare across the past several fiscal years, around that $50 billion mark, and certainly something of concern if revenue is going to remain constrained in the short term. It is important that expenditures become or get under better control in the very near term over the next perhaps 1 to 3 years or fiscal years. So overall, there's going to be low growth projections and another deficit. And as we can see historically, since 2016, real GDP growth has been negative at 5.6% in 2016, and most recently projected at 6.8% in 2020. Again, that IMF projection for 2021 is around 2.6%, but that could falter with lower overall consumption activity and spending activity, as we'll discuss very shortly. That deficit stands at $8.2 billion for fiscal 2021, or 5.6% of GDP, which would be a fairly significant deficit in the context of recent history, the third largest, as a matter of fact, following the $16.8 billion in fiscal 2020 and the $13.5 billion in fiscal 2017. So how are we going to bridge the fiscal deficit? Well, there are several measures that were put forward. While no specific mention was made of withdrawals from the Heritage and Stabilization Fund in fiscal 2021, it is available when needed. And certainly, if those revenue projections do not meet expectations, the HSF would very likely be one of the primary sources of very quick and easy access to bridge that gap. In his budget statement, of course, the minister, again, did not make any mention of withdrawals from the HSF for fiscal 2021. Borrowing, however, was mentioned, and that debt to GDP number is what has been continuing to climb. And as we can see, after hovering around that 62% range for fiscal 2017 to 2019, that debt to GDP figure has climbed to an estimated 80% at the end of September for fiscal 2020. And based on Bourse's own projections, we would estimate that the debt to GDP figure, all other factors held constant, would get to somewhere in the 83% to 85% range for fiscal 2021 on the heels of increased borrowing to fund the fiscal gap. Now, the number is important, but it's not necessarily a bad thing in the current environment. We can see that historically, domestic debt to GDP in that dark blue figure has hovered around 41 to 45% of overall debt to GDP, with external debt to GDP hovering around 16 to 19% most recently. And we expect that domestic debt reliance will be, in fact, the flavor of the day for fiscal 2021. Why? Well, borrowing conditions remain quite good for now, at least, or especially rather, in the local banking system or the local financial system. And we can see commercial banks' excess reserves have climbed from $3.5 billion in December 2018 to around that $12 billion mark mentioned by the finance minister in September, but central bank data as at August was 11.6 billion. So we can see a very significant increase brought about by reductions in the primary reserve requirement, reductions in the repo rate, etc., which would have led to a very sharp increase in excess reserves, meaning there's more free cash, if you like to look at it that way, for the government to be able to tap into. Government borrowing costs on the international market for 10-year Trinidad and Tobago bonds right now, denominated in US dollars, hover at around 4.5%. Over the past 12 months, that cost of funding has fluctuated quite widely, from as low as 3.6% in February to a high of 8.2% in March of 2020, at the peak of the COVID crisis. Locally, however, those borrowing rates have been much more stable over the past 12 months, between 4.4% to 4.7%, and it's currently at the top of that range, that 4.7 figure. And again, it is reflective of very limited bond availability right now, and very significant liquidity looking for a home by investors, pension funds, institutional investors such as insurance funds, mutual funds, as well as retail investors. So we do anticipate significantly more borrowing over fiscal 2021. And finally, in terms of bridging that fiscal gap, we see asset sales being expected. Two of those most notable asset sale announcements in the budget included the Port Authority operations, which would be privatized. No investor has been announced as yet, and it remains to be seen what impact, if any, that would have on the cost of clearing goods, whether it would increase or decrease, and the time spent for goods on the port itself. NP-owned gas stations are also going to be on the chopping block, with roughly 60 of 125 odd NP gas stations being owned currently, but dealer operated, and preference will be given to those operators to sell or to purchase rather those NP-owned gas stations. And of course, it would not come as a surprise if there are other sales of assets which come up during the course of the fiscal year. The big question, however, for investors is whether or not these sales will be done on a private basis or whether they were done via initial or additional public offerings to the public. So, what were some of the fiscal measures that were mentioned, and how are they going to impact, or what potential impact could they have on investment markets, capital markets, the stock market, the bond market, etc.? Let's take a look at some of the major measures that were proposed from an investor perspective. The first, of course, would be the personal income tax allowance being increased from $72,000 to $84,000 per year, which means that if you earn up to $7,000 per month, you don't have to pay any taxes. So that is good news. It translates to about, on average, $250 extra in spending power per month for persons earning $6,000 and more. It will result in a loss in tax collections to the state of $750 million, with an expected benefit to 250,000 taxpayers. And it is anticipated that the multiplier effect of that money going back into the economy would outweigh the loss of direct collections. What are the investor implications? Well, that $3,000 in annual extra spending power should be able to catalyze the economy, all other factors being held constant. However, not everything else is going to be held constant. This benefit could be more than offset by other fiscal measures, which we'll discuss very shortly. And most importantly, there is no impact on lower income earners, that is, persons earning less than $6,000 per month. The SME or small and medium enterprise stock market listing incentives was another fiscal measure. Proposed was a full tax holiday for the first 5 years of SMEs listed on the stock exchange and a 50% tax holiday for the second 5 years of your listing. Now, the investor implications in the short term is that stimulation in terms of new listings and new investment opportunities, in our view, would appear unlikely for a couple of reasons. One, there's going to be weaker business performance, heightened economic uncertainty, and fairly muted investor confidence. Those three items combined don't make for a very compelling story for a company coming to the market to list. And in that regard, listing success would require compelling valuations being offered to investors, which means selling your company or selling new shares in the company for much less than it would ordinarily be valued at, or a solid business case, which is quite a challenge for even the most stable business under the current circumstances and uncertainties that prevail. The fuel subsidy elimination, that has been perhaps one of the most hotly debated topics over the past few days since it has been announced. Now it's been referred to as the fuel market liberalization, but the proposed measures essentially include the removal of fixed retail margins for all liquid petroleum products, gasoline, diesel, kerosene, etc. Dealers are now able to set their own margins, which means they can set their own prices, and there is no regulation on pricing as of now based on the proposed measure, which means we are going straight to market-based type pricing. There will be a fuel tax on wholesale prices, which means that the reverse subsidy which the state was enjoying in recent times would be preserved. And the exact quote was an appropriate and reasonable tax to be placed on wholesale prices. Now, what are the investor implications of this? Well, there is an inevitable price increase coming. Under a competitive scenario where there are many independent gas station owners that are not coordinated in any way and that compete solely on price, inflationary pressures would be more manageable. Under a less competitive scenario, however, which is the concern of most citizens and investors, cartel-like behavior with an oligopolistic market structure, meaning a very small number of owners controlling the gas station network, that cartel-like behavior could result with a higher chance of collaboration, leading to intense inflationary pressures where prices are allowed to drift upward with very little regard for, or very limited regard for market-based pricing. Now, let's take a look at just how high fuel prices could go. When we compare mid-grade gas prices at the US Gulf Coast, pump prices versus Trinidad and Tobago in TT dollar equivalent per liter, what we would notice is, and mid-grade gas prices, by the way, are talking about a 90 octane gas octane rating, which is pretty comparable to our super, which is around allegedly 92 octane rating. US Gulf Coast pricing in fiscal 2020 averaged just around $4.06 TT per liter, as compared to Super's pricing of $4.97 per liter. That means it's about 18% cheaper on this very simplistic comparison. This would not, however, consider freight, taxes, any other duties, and associated costs with getting fuel into Trinidad from the Gulf Coast and to the pumps, as well as producers or dealers rather, their profit margins. When we take a look at diesel prices, it's a little bit more concerning. US Gulf Coast ultra low sulfur diesel is priced at around $4.42 per TT dollar equivalent per liter, which is about 30% more expensive right now on this very simplistic comparison to the $3.41 per liter price of diesel that Trinbagonians rather currently enjoy. Now, that may not provide a very apples for apples type comparison. There are certainly several factors which could impact that pricing. So we took another approach to determining what fuel prices could look like in a less regulated market. So we turned to our Caribbean peers, in particular Barbados, the Bahamas, and Jamaica. And what we noted is that the average Caribbean premium in terms of diesel prices across Barbados, Bahamas, and Jamaica is about 110% more than the Trinidad and Tobago price, meaning that prices could double if they move to more Caribbean relative level pricing. And for gasoline, or super gasoline in that those bright green columns, we would note that the gasoline is on average about 67% more expensive than the current super price of $4.97 per liter in Trinidad and Tobago. So certainly those factors and that information could cause some concern among investors, and of course higher fuel prices, particularly for diesel as well as gasoline, would impact everything or every aspect of life and stoke inflationary pressures. So it would be very interesting to note what we can expect in terms of fuel price adjustments upon the liberalization of the fuel market and the move from fixed to floating pricing. Another aspect of the cost of living that was proposed is the review of the Water and Sewerage Authority, and more specifically, a review of water tariffs. Now, among that proposed measure, a report is due in November 2020, so very soon, just about 2 months away, which would cover a review of WASA operations, including their rates. And it was noted, and it's been discussed and in the media and in the public discussion for the past few months, that an increased rate of water utilities is going to be quite likely. The timing of this increase, however, is fairly uncertain. Now, what does that mean in terms of investor implications? Well, again, inflationary pressures are likely. It could have, depending on how this increase is, or the pricing basis of this increase is implemented, it could have a potentially disproportionate impact on lower income households. And for everyone, lower income, middle income, or higher income, it would result in lower disposable income. Now, again, we wondered what could water rates look like? And we took a Caribbean comparables approach, and a report published in 2018, however, based on 2015 prices by the Regulated Industries Commission, or RIC, would have noted that in Barbados and Jamaica, for example, the cost per cubic meter of water is roughly $1.35. Bahamas is there for uniformity. However, we didn't consider them in this particular comparison. So $1.35 per cubic meter in comparison to Trinidad's 27 cents per cubic meter in US dollars for water, which means that Barbados and Jamaica on average pay around 5 times more for their water rates than Trinidad and Tobago currently does, based on the available data, that is. Electricity and the tariff review that is upcoming, the Minister of Finance alluded to a very likely increase in the price of electricity. The timing, again, is uncertain, but it could affect up to 500,000 approximately customers when the increase does take place. Like water, inflationary pressures would be quite likely. It will have a potentially disproportionate impact on lower income households, depending on how it is implemented. And for everyone, low income earners and high income earners alike, it would result in lower disposable income. Again, taking a look at Caribbean comparable pricing, we would note that currently Trinidad and Tobago pays roughly US 5 cents per kilowatt hour for power. These are residential rates, I'm told. The Bahamas, Barbados, and Jamaica, on the other hand, that cost is roughly 28 cents, or average 28 cents per kilowatt hour, which means that Caribbean comparables pay roughly 5.5 times more than Trinidad and Tobago for their power. Now, that is not to say that this is going to be the adjustment in pricing. A study done in 2017 suggested that the fully loaded cost of power in Trinidad and Tobago, meaning to eliminate the subsidy, would be around 12 cents per kilowatt hour, and that's in US, of course, which means that there could be a roughly 2.5 times increase if this elimination of the subsidy is the main goal of the electricity rate adjustment. So certainly fairly significant inflationary adjustments or proposed measures would have been mentioned in this budget. And of course, only time will tell how these unfold, and it all depends on the price and the method of pricing, of course. The property tax. This has been perhaps the worst kept secret and the longest running saga in terms of fiscal measures for the past perhaps decade or so. Now, the proposed measure is that it's not fully perfected as yet, so residential taxes are going to come first. The determination is still somewhat subjective, and we have an example shortly. And the timing is fairly uncertain. It was just noted that the implementation was for fiscal 2021. In terms of investor implications, well, inflationary pressures are likely, as with all the other measures recently discussed, and it could result in lower disposable income. Unlike the other measures, this would relatively affect property owners. Typically, higher income earners would have higher value properties, which would attract higher rental values, and those would be subject to greater degrees of taxation or property tax. Now, calculating the property tax is, again, fairly subjective in terms of getting to this annual rental value. And I mean, I would appreciate if we do have any experts listening in that would contact us to share how, perhaps shed some more light on the calculation basis. But just for argument's sake, we looked at a couple 3-bedroom, 2-bathroom houses in the Central District, and on average, those type properties were being offered for rental at $6,000 per month, which would mean the annual rental value, based on pricing on certain real estate websites, is around $72,000 per year. The annual taxable value would be 90% of that ARV, making some provision for vacancies. So the annual taxable value would be at $64,800. The tax per year for residential rates is 3% of the ATV, which would work out to about $1,900 per month, or $1,900 per year rather, which works out to about $162 per month. So owning a fairly modest 3-bedroom, 2-bathroom home in a relatively unexclusive part of Trinidad and Tobago, and we're talking about less non-gated communities where property values aren't fairly significant or elevated, it would cost you $162 per month extra in terms of taxes, which would whittle away for persons earning $7,000 or more, that whittle away at that $250 extra that you would be benefiting from that increase in personal income tax allowance. So, tobacco duties is another stock-specific fairly measure that was proposed. Excise duties on locally manufactured tobacco products, as well as custom duties on common market origin and extra-regional tobacco products, are expected to increase by 20%, effective October 20th, 2020. And the investor implications would be fairly specific to publicly listed West Indian Tobacco Company Limited, or WITCO, which would face increased challenges in having to pass through increased excise duties to their customers through higher product prices. However, the fairly inelastic demand and strong pricing power of Whitco based on the slightly addictive nature of tobacco products should support profitability in the short term, all other factors held constant. And motor vehicles matters. Much of a deal was made about this in terms of the removal of concessions, all tax concessions on private vehicles, as well as the imposition of quotas, specifically a 30% reduction in quotas for used car dealers and an unnamed figure or no signal of a figure as yet for new car quotas coming in January 2021 for new car dealers. The permissible age of used imported vehicles was also reduced to 3 years, which would naturally increase the price paid to acquire these or import these vehicles from dealers abroad. The investor implications, well, there could be a further slowdown of private motor sales and associated employment impact, particularly with the over 500 used car dealer network, with less employees perhaps needed, which could mean some layoffs coming. And there are the quotas, depending on how severe they are, could impact the operations of Massey and Antimacassar, two fairly significant publicly listed new car dealers, which cover a multitude of brands across the Trinidad and Tobago and regional markets in the case of Massey. And the removal of concessions, of course, will increase pricing for all vehicles, which would again lead to some imposition or making it more difficult rather to acquire these vehicles, certainly for low and middle income households who would already be feeling the pinch from increased tariffs or potentially increased tariffs, as well as a minor pinch from increased property taxes. Now, what would be the investor considerations, just to sum it up, after considering the overview of the budget as well as some of these fiscal measures? Well, firstly, there's going to be, in our view, increased inflation risks. We view higher fuel prices as being very likely. We view increased tariffs as being likely, and we discussed a potential range of increases and what they could look like. And the property tax introduction would also dent some of that disposable income that would be gained from increased income tax allowances to middle to higher income earners. We expect that with increased bond issuance, there's going to be increased bond availability for investors, but we'll put an asterisk there. There's going to be greater domestic bond issuance. However, as has been the case in the past, there will probably be a preference for private versus public issuance. And the last major public issuance that came to market would have been way back in 2018, I believe, the $4 billion NIF issue, of which an NIF2 was mentioned on several occasions, but no mention was made of it in the most recent budget speech. And again, increased bond availability because of a fairly accommodative monetary policy environment. Simply put, it's still fairly cheap for the government to continue borrowing, both locally and internationally. However, they do have more control working with the central bank in controlling, influencing rather, local interest rates. Our credit rating as a country is going to come under pressure. Debt to GDP, in our view, will continue to climb to that 83 to 85% range over fiscal 2021. In our view, we believe there's still going to be subdued government revenue generation, and perhaps the 41.4 billion would be quite a commendable achievement if it is met in fiscal 2021. And overall, our investment grade rating by Standard & Poor's could be at risk. And why is that important? Losing your investment grade rating would lead to an automatic jump in the cost of borrowing in international markets. So that 4.5% that we could currently borrow at could fairly significantly increase in a short space of time, regardless of how accommodative the international interest rate environment is. However, having taken all of these into consideration, we expect Trinidad and Tobago dollar bond yields to remain fairly low or stable at the very least. We expect persistent financial system excess liquidity to continue. As we mentioned, it's in the vicinity of $12 billion. And there is still room to reduce the primary reserve requirement further by the central bank, which could introduce even more excess liquidity into the market. There's going to be a preference for lending to the government versus lending privately, in particular by lending institutions, which means demand for government paper, government bonds is going to remain fairly robust. And generally, there's a risk of investor sentiment based on the multitude of investors our team speaks to here at Bourse. There is that aversion to risk at this point, given the boundless uncertainty that exists at this time. From a more equity-oriented perspective of investment, the growth story is going to remain fairly challenging. The economy is still going to be reliant on the energy sector and its trickle-down and spin-off effects. Government is, based on their very sticky expenditure, as we mentioned earlier, their role as a growth driver is going to intensify, meaning their spending is going to be much more significant to maintaining economic activity than in periods where energy revenues and a robust manufacturing sector activity is being experienced. Overall, we think, based on the above, that consumption is going to likely be weaker. And why is consumption going to likely be weaker? Just to recap, there are involuntary consumer changes that are about to take place in our view, specifically a higher cost of living, which would be brought about by those increases or potential and very likely increases in electricity and water tariffs, as well as the liberalization of fuel markets and how we compare currently to our Caribbean peers. That's going to lead to reduced disposable income, and there's just generally going to be weaker consumer sentiment. So all of those are going to contribute involuntarily by the consumer to weaker consumption. From a corporate perspective, there are pass-through pricing limitations. And what do we mean by this? How much, if all or any, can companies pass through their increased costs that are inevitably going to come along to consumers in the particular environment? And those are the questions that companies are going to have to ask. Can we pass through all, most, or some, or any of our new costs? Can those consumers absorb those price increases with reduced disposable income that they are also facing? And ultimately, that's going to mean, based on our preliminary analysis, that company profitability is going to be at risk. And finally, we expect all of these factors to translate into subdued company or corporate earnings. There will be, of course, some recovery from peak COVID slowdowns when there was an almost full shutdown of the Trinidad and Tobago economy. However, it's not going to be, in our view, business as usual in the upcoming fiscal year. We do expect unemployment to be fairly elevated. We expect, as mentioned, reduced consumer activity, which will translate into lower revenues for companies. And of course, because of the higher cost and some limitations to passing through those higher costs to consumers, cognizant of consumer circumstances, company operating and net margins are going to remain fairly pressured. So all in all, the outlook for publicly listed companies and private companies are going to remain fairly challenged, and we expect on average lower earnings in subsequent periods after the knee-jerk recovery from that peak COVID slowdown time, which occurred sometime in the second quarter and perhaps into the third quarter for some companies of 2020. So with that, we come to the end of our presentation. We are about 5 minutes over our projected presentation time of 30 minutes. And we are going now to our Q&A session. I am sure that many of us would have submitted questions throughout this seminar or the webinar. And we hope that you continue to submit those questions to us while we answer the Q&A session, and we'll try to get through as many as possible. So the first question, I'm wondering what the outlook would be for companies like NGC in the natural gas industry. Well, NGC will come across its own challenges, but it is a privately owned company by the state, of course. But as a gas allocator, they would be facing pressures from the upstreamers as well as from downstreamers for better pricing. From the upstreamers, they would want to get higher pricing, or would want the NGC to pay higher pricing, and for downstreamers, they would want NGC to give them lower pricing. So their margins could be fairly challenged. However, they should be able to navigate, given that they are the sole natural gas allocator in the country. So certainly, the environment would suggest lower profitability for the NGC, but they should be able to navigate these circumstances fairly well. The second question, the NGC outlook. Well, I'm assuming that's the NGL outlook. Oh, okay, so that makes a lot more sense. The TTNGL outlook, including possible appreciation and return of previous dividend payout of $1.50 per annum. All right, so it certainly was a good run for NGL over the past few years. Understandably, with the capitulation in energy markets, we would have seen an almost elimination of their dividends in recent times, and that would have been reflected in the share price tumbling to around $15 or thereabouts, from as high as over $30 in the past few months. Now, energy is a very cyclical environment, and we would expect that at some point in time, there would be a pickup in prices. In fact, as of today, oil prices, after hitting negative or falling into negative territory way back in April, or it seems like forever and a day ago, they are now hovering around that $40 per barrel mark. Oil prices do fairly significantly influence the production prices of propane, butane, and natural gasoline, and which is what NGL produces, and those would also be recovering fairly well. As a matter of fact, year to date, propane is up and being advised around 25%. Butane is down just around 6.7%, and natural gasoline is down just around 19%. And in the past 6 months or so, which would take us back to the crisis point in time, propane has recovered around 81%, butane has improved almost 80%, and natural gasoline prices have also increased around 80-odd%. So overall, there is recovery taking place, which should filter in to the NGL's performance. Their export markets are also set to reopen very slowly, but they are reopening, and that should also lead to improved performance. From a gas processing perspective, gas production in fiscal 2021 is expected to be around 3.2 BCF for the country as a whole, which is fairly consistent with fiscal 2020. So we should see some stabilization, perhaps, in terms of gas processing revenues for TTNGL through their investee company, Phoenix Park Gas Processors Limited. So overall, there seems to be right now a lot more selling pressure, and that could also be driven by retail sellers trying to exit their NGL positions amidst more challenging personal financial circumstances. However, based on the life cycle or the industry cycle of energy markets, there is reason for cautious optimism. Next question. How about the execution of the digitization plans, or for that matter, any other measures proposed? In short, what is to say at the end of fiscal 2021 year end, we will not be having similar fundamental discussions? Okay, so that's certainly a very complex question. However, digitization is not something that happens overnight, and it could very well be likely that at the end of fiscal 2021, we will be having some of the same discussions. However, I think it's very commendable that at least those proposed measures for digitization have been discussed, celebrated, and in some cases, actions are going to be taken to ensure that those processes get started at least for completion with over the next 12 to 24-month period. Okay, the next question. Although no current intent towards devaluation is expected, what are the major FX challenges we can expect? Also, how would you suggest we as investors acquire FX for trading purposes given current FX restrictions? A very important question. Well, the minister did, as is now well publicized, say that at this point they don't see a devaluation as helping the economy. There were some moves through tariffs and quotas to create selective devaluation, as it were, by making the cost of certain imports more expensive. It still doesn't address, however, the shortfall or slowdown in foreign exchange inflows from the heady heights of very dominant energy production and energy pricing that would have been experienced what seems like ages ago. The answer to the second part of the question, what you suggest as in terms of acquiring foreign exchange, that's a fairly difficult question to answer. We are asked by most of our investors every day how they can acquire this foreign exchange. It all depends on the price that you're willing to pay. Conventional approaches, which is going to the bank and requesting it, are pretty much non-existent now for most of us, and the quantities that you would get would be fairly insubstantial or inconsequential for trading. But there are no conventional ways to easily access foreign exchange for FX trading, but which, full disclosure, we don't recommend, or other types of trading, like trading on international markets, which we do recommend. Is it likely that the government will implement price ceilings on fuel prices when prices begin to float? That is a fairly important question, and based on what we have seen in terms of Caribbean pricing, as well as the concerns about what the market structure in terms of suppliers will look like once as the privatization of NP gas stations are completed, we would certainly hope that there could be some partial regulation in terms of a maximum margin that could be set. Certainly nowhere near the existing margins, which would have been of great concern to existing petroleum dealers. However, at the same time, we would hope that there would not be a fully unregulated market, which could stoke, as we mentioned, fairly significant inflationary pressures if prices are exorbitant. What are the implications locally of negative interest rates abroad? Well, that's a good theoretical question. In theory, if foreign exchange was easily accessible, negative interest rates would, in the US, would lead to some repatriation of foreign assets or liquid currency back into Trinidad and Tobago, which would boost or should boost foreign exchange reserves and help in terms of keeping interest investment or investment interest rather fairly robust in Trinidad and Tobago fixed income instruments and other alternatives. Now that's in theory. In practice, negative interest rates abroad may not do that because ultimately, in our view, there is some level of lack of confidence in the Trinidad and Tobago dollar, and investors with US dollars, particularly abroad, would probably opt to keep them even in a cash account or in perhaps equities, which would do fairly well, US dollar denominated equities, that is, which would do fairly well in a negative interest rate environment because equities would typically pay some dividend yield, and yield-hungry investors would pour into equity markets or US dollar equity markets, all other factors being held constant. What do you advise about investing right now? Well, it's a very uncertain time, that much is sure. And in terms of investing in uncertain times, you could look at shorter term, fairly secure investments like income mutual funds that have fixed NAVs or stable net asset values. You could look at repurchase agreements. You could look at short-term government guaranteed bonds if they are available. You could look at the National Investment Fund bonds as an alternative. For example, the NIF Series A matures in 2023, so that's just about 3 years to maturity, and it is collateralized almost 200%, which means there's a fairly low probability of losing any of your capital unless there's a sharp deterioration in asset values in that fund, given that it's collateralized by a fairly significantly healthy assets, including Republic Bank Limited, amongst others. We see that as being unlikely. So in the near term, with uncertainty fairly high right now, looking at safer, shorter-term investments could be beneficial. The equity markets are fairly, again, uncertain, and the outlook is a little bit bleak right now, barring any introduction of new opportunities. And as a matter of fact, I think Bourse, based on its research, has only one buy recommendation, which, if I'm not mistaken, is the Kiko Investment Fund, or CIF. And even the CIF will have challenges in terms of the dividends that they pay, given that they rely to a significant extent on dividends remitted from Republic Bank, which comprises about 90% of the fund, which would have reduced its interim dividend payment by more than 50% earlier this year. And the final dividend for RFHL will play a very significant part in determining the dividend that CIF, or the distribution that the Kiko Investment Fund, can pay. With respect to property taxes, do you think landlords will substantially increase their rent? If so, it seems like the lower income persons, I don't want to say poor, will be facing the brunt of the property tax. That's a good observation. However, residential tax rates will be coming in first. Properties that are available for rental should really be classed as commercial, I would imagine. I'm subject to correction, and they would not be levied any property tax at this point in time. I think we had one question just before that one, and that was, which government asset do you think might be offered in an APU or IPU? And do you think there'll be another NIF offering? Well, the NIF offering was mentioned, and it's been perhaps misleadingly referred to as non-debt financing. A bond is a bond is a bond, whether or not it's a secured bond or not. And the NIF2 was mooted for some time. However, there's been no mention of it in recent times, and therefore, if it does come, it would be quite a surprise to us, certainly. In terms of IPOs or additional public offerings, thinking out of the box, one of the approaches to the privatization or the liberalization of the fuel markets could have been the formation of a gas station dealer company, which could have been IPO'd. Therefore, increases in prices that will pass through to consumers, they would have a chance to get a piece of that through higher earnings from owning a gas station operating company. Otherwise, it's fairly obscured in terms of what could come as an IPO at this point in time, or an additional public offering. First Citizens comes to mind. National Enterprises, two fairly significant holdings by the state that are already listed, which could be further divested, with the state still retaining control. What is the outlook for what's the outlook for government bonds, or the last outlook for government bonds? It was BBB-, stable by S&P. Our annual review by Standard & Poor's is usually April, or around March to April. And otherwise, I think CARICRIS has maintained a fairly stable credit rating for the government of Trinidad and Tobago TT dollar bonds as well. Another good question, do you think these measures and I'm assuming the tariffs and quotas will stabilize the excess demand on US dollars and therefore increasing availability. So that's a really excellent question. Now, vehicles demand, as mentioned by the Honourable Minister of Finance, is about 7% of overall demand on foreign exchange or usage of foreign exchange, with food being about 11%. Even if there is a reduction in vehicle purchases, it appears to be unlikely that it will stem vehicle purchases rather that much and the foreign exchange requirement. What it will do in the case of used cars is that because of a shortening of the average life to 3 years of used imported vehicles, it would make those vehicles just to acquire by a used car dealer more expensive, and in turn pass that cost through to a potential consumer or would-be consumers. What that means is, while there may be lower unit sales, it's not a guarantee that there would be absolute lower usage of foreign exchange with respect to used cars. And in the case of new cars, well, there's still a fair amount of uncertainty into what the quota would look like and whether or not car sales are currently below the quota or not. So it's fairly uncertain. All right. Do you anticipate increased pressure on the de facto fixed exchange rate? That's an interesting question. There will be the fixed exchange rate is managed, so de facto fixed. The minister, having said that they don't think a devaluation is in the best interest of the country right now, would probably give some time for the newly proposed measures to work into the economy before making a determination as to whether or not that our current rate or official exchange rate would be adjusted. Having said that, if things don't change materially by the mid-year review, things could change fairly quickly. Given the current context, what would be your recommendation for US dollar acquisitions for international trading via Bourse? As investors, we experience significant challenges in the acquisition of USD, which prevents the basic funding of accounts. I think we covered that question already. It's a fairly challenging environment. We are not an FX dealer, unfortunately, and therefore, and priority at commercial banks are not given, unfortunately, for investment purposes. So in that regard, it's going to continue, we feel, to be a fairly challenging exercise in getting foreign exchange. With such a gloomy forecast, what can we as investors do to ensure our current equity is sustainable for our retirement? All right, so there are a couple of things that could come into the fore or could affect this. Again, investing is a long-term process, and it all depends on how you manage your portfolio or who manages your portfolio. So for retirement in particular, we at Bourse have our individual retirement fund, and depending on how we view markets, we do see changes in portfolio allocation in the coming months and perhaps years ahead, switching more towards government bonds, which would be income generating and income generating in terms of the interest, as well as very stable in terms of capital preservation. Otherwise, the equity market, the banking sector has been traditionally viewed as very stable. They will, however, come across certain challenges in the next 24 months or so. Consumer non-discretionary could come under some pressure, but they tend to be a little bit more stable. But generally, it's a fairly challenging outlook for equities. So I would imagine that persons would be allocating or should be allocating more of their portfolio towards fixed income, lower risk type investments, at least until things become a little bit more certain. All right. The privatization of the Port of Spain Authority, Port Authority of Port of Spain was a significant mandate by the government of Trinidad and Tobago. What's the impact on the cost of living envisaged? Well, again, it all depends on how the private sector investor transforms the company, what the capital investments by that private sector investor are, and how this translates into pricing for importers and persons who use the port for import and export purposes. So that is fairly uncertain at this point in time. We do expect some rationalization of resources at the port, as would have been mentioned by the Minister of Finance. So right now, we would like to view it as a net positive in terms of a fiscal measure, but it's difficult to quantify at this point. For the economy to grow, you indicated the state must be the main driver, but it doesn't seem, or there doesn't seem to be any apparent signals of what areas there may be meaningful opportunities. Will there be a reliance on the private sector, and how does that impact investor opportunities, venture capital mechanisms, for example? So that's an excellent question, and venture capital and private equity type investments have been, discussed at great lengths over the past, as far as I could remember, decade or so, in terms of revitalizing our financial markets. Not much progress has been made past the discussion so far. However, it's a brand new environment. There's not quote unquote easy money as there may have been over the past few years, and it may require much more entrepreneurial views by investors as well as business owners in terms of generating activity and finding new business opportunities. They spoke about a technology investment fund. We would hope that at some point, although no mention was made, that is something that becomes listed or made available for the public to participate in as an incubator or potential mutual fund type investment that's listed. There was mention made of the agriculture stimulus. We would hope that something in terms of an agricultural investment fund would be made available, of course, with suitable leaders and operators of that fund would become available to investors, because the one advantage that Trinidad and Tobago and the investing public has going for it right now is that as a country, on average, we are fairly wealthy. And therefore, there's a lot of capital that can be mobilized. However, we need good ideas to put that capital into. And I'm sure over the next few years, opportunities will arise. However, it's been very long in coming over the past decade or so. Which state entities do you see being privatized next? That's an excellent question. There was talk about creating a vehicle which took our expertise in project management and privatizing that, or leveraging it at the very least. But a state entity that would be privatized would have to have, just like SMEs, a fairly compelling value proposition for investors to be incentivized to put their money in it, given the typically risk-averse nature of the Trinidad and Tobago psyche, investment psyche that is, which is also why venture capital and private equity type opportunities have been slow to start or a non-starter until perhaps now or to present, probably because we haven't been as aggressive in putting capital into these areas. Is the housing sector attractive for an investor after the recent announcements? attractive in the sense of, well, I think we need some more clarity on that. But overall, properties or property investment may not necessarily be more or less attractive, rather, with the recent announcements. Perhaps for private developers, given the outline for certain building incentives, it could be. But given weaker consumer demand, because a lot was made about supply side incentives, but demand side incentives doesn't make for, but particularly it doesn't raise any eyebrows positively in terms of saying that, yes, the housing sector is very attractive or is now much more attractive. All right, so we'll just take about 2 or 3 more questions. It's about 4:05. At Bourse, so I think we covered that one already. With the rise in cost of living coupled with increases in tariffs or increasing unemployment, banks could see rising defaults. Could this transition to a drop in a quite expensive housing market? That's a very good question. It all depends. As mentioned, there is very significant capital on the sidelines in terms of wealth, and a drop in the housing market could be quickly snapped up in one scenario by very wealthy persons and put out into the rental market, as opposed to being available for a very long time for retail investors to acquire their first home. That's one particular scenario. However, again, if things deteriorate fairly sharply, I've always been told about the experience of the late 80s into 90s, where people just left their keys on their doors. I was quite young at that point in time. But that experience, I don't know that we're going to see that again, because the wealth effect back in the late 80s to early 90s, as opposed to the wealth effect now, is markedly different, in that there's significantly more wealth available to absorb assets, particularly in the real estate market. Okay, let's take a last question. And we're going to... Do we expect life and medical insurance premiums to increase due to COVID and restricted budget or economic activity? That one is a little bit outside of my expertise. However, I mean, insurance companies are going to see increased expenses as a result, and they may want to pass through some of that pricing, as we discussed earlier, to their customers in the form of higher premiums or rates. All right, and very last question now, going right up. Let's see. No more questions, guys? Okay, I think we've answered most of the questions that would have come in. And I just want to take this time to say thank you to everyone who would have tuned in and contributed in terms of asking questions. And of course, I'd like to thank my investment team, who would have worked very assiduously to put together this presentation and to dissect the data and consider what we as investors could look forward to in the coming months or years. As usual, for all those questions which we may not have answered, we may have overlooked, we'll put them out in our Q&A document. And we have also done a very concise overview of the presentation, which we would also email out to all of the viewers as well as our investors. So again, thank you everyone for staying on with us. We had quite a nice attendance, and we'll see you at the next edition of our webinar series. Thank you and have a wonderful